Property is a game of finance. If you can access credit, you have access to the property market and you can grow your portfolio and grow wealth through property. We're going to talk about 10 lending hacks, lending secrets, lending things that you do not know. You may know, but most of you will not know. We're going to talk about the perks of our job, understanding lending policies, little tricks and trades, what our experience teaches us about the loopholes, the little things that you can do to access credit that you may not know about. People can get money where they don't actually have income. You can do it on the back of assets itself. That's commercial lending. We're going to talk about commercial lending. We're going to talk about how SMSF lending looks now and why it's attractive. We're going to talk about self-employed borrowers. We're going to talk about all these little tricks that are out there, 10 of them in particular, to get you more bank money and to help you grow wealth through property. Curtis, the man of the hour, the expert, the gun, the whiz. That's what I call you when it comes to this sort of stuff. You came up with most of these 10. I was like, whoa, look at my guy.
Yeah, I'm excited for this one. This is like, can I put my day-to-day job on a podcast? I'm like, yes, that's very easy. I can do that.
Yeah, this is the way we work. So for those who are new listening, I don't know if there's too many new people listening now. We've been in for over 60 episodes. We are property nerds. We are finance nerds. It's just who we are. It's our personalities. We're ex-treasury economists for a reason. They hire nerds. We found our way there and we have kept that ethos in everything we do. Whenever we find something that we don't know, it gives us a little, yay, what a little giddish smile we get. Definitely me. That is how I feel when I learn something I don't know, particularly when it's related to my field. And this is what we're going to go through. So let's start with commercial
lending. Let's do commercial first. So the first few tips I think we'll do for things that aren't in your personal name, which might be a little bit more unique for some people that aren't experienced in that.
Yes.
But yeah, commercial.
Yeah, so let's go through a recent deal. We've just funded a huge, one of our biggest deals that we've ever done, commercial deal, an office building, the whole building. Like amazing purchase. I thought it was a stunner in terms of the numbers. It's like, wow, I see why people invest in commercial. But the reason I want to talk about this from a financing perspective is you don't actually need to show any income. There were no personal income checks here. There were no other income checks outside the asset itself. It was a complete asset lend. And this is the major bank we're talking about. And it's not one major bank. They're all fighting over it. And they're all having the same lending policies. What we have now in this marketplace is the resi lenders, all the big banks that we know of, are fighting at lower margins.
Yeah.
And as a result, they've kind of shifted their strategies a little bit and been like, can we get more of the commercial lending pie? And what do we need to do to go and get it? So the old school lease doc lending, where banks will lend on the asset based on the lease of that asset and how much rental income it is producing. That is no longer a shadow banking, non-bank thing. That is a major bank thing. It is at interest rates that essentially are the same as residential investor interest rates, cheaper in some cases, marginally. And there is pretty limited upfront costs. Obviously, valuation costs are a little bit more, but there are limited upfront costs associated with it too. So if you are a high net worth person and you have a lot of capital but not much income and you want to invest in property and you want to leverage, commercial real estate is where you should look at the moment. If you can't get money because interest rates are really high, you can get commercial lending and commercial debt against commercial assets pretty easily. You just need to set up your affairs appropriately, buy the right type of asset, and a lot of commercial assets fit this, have good quality leases in place. Ideally, it's fully tenanted, like not an empty property, because that's going to be hard to fund, but a tenanted commercial investment property, put in a large enough deposit and you're going to get funding. You're going to get a 65% LTV fairly comfortably with a major bank at cheap interest rates with low fees. It's an amazing product. It solves the problem of, I don't meet servicing, I don't have income, go buy a commercial asset. Now you can make it work.
Yeah, banks are looking to get these deals done. They're looking to get them over the line. Yeah, in residential lending, they're limited in what they can do. If it doesn't pass servicing, if it doesn't meet the boxes, they actually can't do anything. They have to decline it. It can't work. 100%. In commercial lending, they have a bit more flexibility where if it makes sense, if it's 65 LVR, if it's leased out, they will go out of their way to make the deal as easy as possible to get over the line. Like, they're not going to have to trawl through everything. Like you say, if you set up your affairs in the correct way, they're going to find a way to get it done. And like you say, it's not just, private lenders and little non-banks that are going to offer some unique solution. The big players are there at good rates trying to get your business.
Yeah, I love this. This is not always been the case. We, years ago, these sort of deals would have been done with the non-banks who have products specifically attached to this. That was a fairly not so popular product, but those that wanted it could access it. But now it's major banks offering this and at really good terms. So that's really the key difference here, and being able to access it. It's pretty attractive for those that want a big asset, those who have high net worths, because you're going to need to put in a big deposit.
Yep.
And those that are kind of done with resi lending or capped out at resi lending and want to go and get more money. That's who it really suits. Commercial sort of property transactions, that the financing is just so much better at the moment for it. And yeah, it's very, very attractive for a large group of property investors who can now look at commercial property as a way to continue to grow, scale their portfolio. And then there's all the other benefits. There's so much income to this. The net income from these arrangements, it's pretty good. Every residential property you're buying now is negatively geared, pretty much. With commercial properties, you can find properties that will put money in your pocket and then will pay off all the debt too. So it's spinning off cash flow, free cash flow that goes straight into your pocket as a result, which is fairly attractive because it can fund your residential shortfalls, or it can add to your income that way. You're getting rates 6.65, 6.7 in that sort of territory. You can get an 8% yield. If you get a 35% deposit there, just depending on the size of the asset you have, you're going to be in a really strong positive cash flow situation, particularly if that deposit is cash deposit, or a deposit where you're not borrowing. That is going to spin off a lot of cash flow. And even if you're borrowing the deposit, you're going to be spinning off that difference in the net yield versus the interest rate, which can often be a percentage point plus. So fairly attractive. And it's a good way to buy land holdings too, because a lot of quality land holdings that we talked about in our previous podcast, Alpha Property Returns, a lot of quality land holdings are actually commercial assets. So really good,
There's some upside there. Yeah.
Yeah. Super, super attractive. Commercial lending, I don't like basketing it with that word because there's so many commercial lending products out there and there's so many different spectrums. Some do servicing tests. Some, there's business lending. It's just a huge group of lending. But this is what I call asset lending and lending against the asset itself. And it's previously called lease stock lending. They don't actually basket it with that name, but it's effectively lending against the lease of the asset you're purchasing. The things that I'd add to your structuring, if you're going down this route, ideally have it in a company name or a trust. Ideally have it separate to your other items in your portfolio. So, if you've already got a trust and company with lending in there, then you may not be able to get further funding because that debt will need to be considered. But if you've got a new entity or a dormant entity or an entity that doesn't have other debts, then you're likely to get the bank to fund it against that entity itself, and be a bit more flexible as to what's going on inside your personal portfolio or your other entity portfolio. So that is a structuring thing that you'd want to do. You want to be buying decent quality assets with yield in place. If you're getting 7-8% yield, it'll almost cover itself. And in terms of how servicing works, how are banks actually running the servicing here? They're doing what you call like an interest coverage ratio test. So this is a serviceability test that they do. Yeah. And the way it works is they essentially see how much interest you're going to be paying. So let's just say you buy $1 million property, or you get $1 million commercial loan. The interest that you're going to be paying on that, on an interest-only basis, call it $67,500. So that's 6.75% of $1 million. You need to show enough income to meet that $67,500, multiplied by somewhere in the vicinity of 1.25 to 1.5, depending on the commercial lender itself. So, putting that really, really simply, I haven't done the math in my head; it's really testing me here. But 67,500 multiplied by 1.5. Those watching our YouTube video will see me quickly jumping onto my calculator and noticing that my speed math is not
failing here at the crucial moment.
Roughly $100,000 in income. So if you can show $100,000 in income from the leases itself, the net leases, then it will cover the property transaction and they'll give you the loan. That's essentially how our latest deal was covered. It was a much bigger loan and much bigger numbers, but really that's
Same
exactly
principle.
how it worked. Yeah.
Yeah, and I think I guess the high level thing to note might be just that the relative landscape has changed a little bit. So one of the things that a lot of you would have noticed over the last couple of years, residential lending's got harder. Like relatively, banks are making commercial lending easier. So if you're thinking about how to grow the portfolio or your asset mix, like that is something that has moved.
Yeah, exactly. So doing it really, really simply there as well, adding in a little bit more color to those numbers. For that $1 million loan amount, if you're getting a 65% LTV on that, you're going to be purchasing roughly at 1.5 million. Does that sound right to you, Kurt?
Yep.
So let me do that. Yep. So roughly 1.5 million. I'm splitting it out a little bit, making it a bit simpler, but roughly 1.5. A bit more than 1.5 million, you're getting $1 million loan. If you get a 7% yield on that, or high sixes, which a lot of commercial assets have, it's funding itself. You just provide the 35% deposit. That's all you need. Tick. Loan approved. You go purchase whatever you want. Just do it in different companies, and you can keep getting your commercial lending that way. And this is a really good way to access leverage, grow your portfolio, grow wealth, and make the size of your portfolio larger if you're happy to invest in assets like this.
Yeah. So who does it suit? Like you say, high net worth individuals, people that have a deposit base.
Yep.
Like that's the thing that you can't really compromise on when you're looking to do this type of a deal.
Yep.
Like if you want to do tiny deposits, it's not going to work. But if you've got a solid deposit base, then the world's your oyster, basically. That's who benefits the most out of this.
Exactly. It's the best no income product there is. There are other private lending products, which are short-term lending sort of options, which we haven't covered in these 10, but there are products like that out there, but they're not that attractive. It's really expensive. You're looking at rates close to 10. There's 2-3 percentage points in fees. They're shorter loan terms. They're not that great. They're only good for like land banking or for situations where you think you're going to get a return and you're going to get out very quick, or you're in a jam, really. That's the situation where you use those lenders. This is the only financing option of our 10 where you don't actually need to show any income from your own personal position at all. And let's touch on the second one too. Let's delve into it, where it's about SMSF lending. That one is also a beautiful thing about that is if you're capped out in personal lending circumstances, you can use your super to go and purchase.
Yeah, exactly. So it's another one that I would say relatively has gotten easier over the last couple of years compared to residential lending. And like you say, best part of it, your entire personal position is excluded, basically. All your personal liabilities, not relevant. The SMSF is its own little, own little entity away from everything else. Nothing impacts it, kind of thing. That's how it's treated. So that has a lot of servicing advantages for people that already have large portfolios and debts in their personal name. So typically, again, the SMSF funding is paying itself, as in the lease, the rental income from the property, whether it's residential property, commercial property, is essentially covering the SMSF loan. Yep. Plus, you have the option to include any SMSF contributions that you're making to your SMSF, whether it's you and your partner, you by yourself, that can be included. But banks are running a very, very streamlined servicing assessment, where as long as that combined income, so the rent and the SMSF contributions, can cover the mortgage, that will get you your loan approval. And I think one of the big things that we've seen that has made this so much more popular maybe over the last couple of years, rates are much more competitive now. You're talking, some providers are sub 7%. You're getting very close to residential rates.
Exactly, yes.
In your SMSF. Yep. A while ago, that wasn't the case. If you wanted to do things in your SMSF, you were paying a pretty hefty premium in terms of fees and rates. Now you're looking at near resi rates, pretty low fee products if you want to enter that space. Yeah.
The majority of this space is in the non-bank space, so that's one difference. The major banks are all largely out of SMSF
that's
lending.
true. Yep.
Post-Royal Commission or in and around there, they all sort of left the gates being like, we're not touching that, too risky in terms of compliance. So the non-banks have stepped up and, product rates sub 7 or early 7s, and that isn't too far away from residential investor rates. That's a big perk to it. In terms of a simple servicing test, if you really want to do this yourself, I really like SMSF servicing because I can do it with a quick calculator.
Yep.
Again, for those watching YouTube, I'll need to do it if I was doing a live one. But let's just say a couple earning $100,000 each. Your contributions to super is 11.5%. coming up. So that's 11.5 grand each. That's $23,000 every year you're contributing to super. Let's assume you have no additional superannuation there at all. You're not voluntarily putting in more. You're not going all the way to the $30,000 concessional cap. You're not trying to do that. You're just putting in the minimum amount from your salaries. Now, you got 23.5 grand in income in your superannuation. Plus, let's say you buy a property for $500,000. That's renting at 700 a week. Really, really high. That's probably too much. 600 a week. A really high yield, which is what most assets are in superannuation purchases, at least for the investor clients that we see. For the most common investor clients, that's what they're buying. The high net worths might be a bit different, but the majority of investors are buying pretty strong yielding assets in their supers. So, that's adding another 30 grand in rental income. The banks will take 90% of it. So call it 24,000. That's 80% of $30,000 in rental income that you're getting per year. So you've got those two income streams coming into your super. You've got 24 grand in net rent that the banks will include and 23,000
in contributions.
Tax your contributions at 15%. So you'll get roughly, a little bit under 20 grand. Plus your
18,
a little bit under 20 grand, plus your superannuation rental income, roughly 24. So you got, early $40,000 in income available in your super, and that's what you can leverage off. What banks are going to do is have their, 7% rate over a 25, 30-year term with a buffer associated in there, and that's how they're going to work out the loan amount to you. What can $40,000 or $42,000, how much of a loan can you get with that income? That is exactly the servicing test. It is that simple. You're not looking at your personal expenses, whether you have Netflix, whether you have, private schools and things like that. It's all excluded. They don't want to know. It's just your superannuation. It only has a couple income streams. It has no expenses other than the property itself that you're purchasing and the mortgage that's going to be attached to it. It's a very simple calculation. It's become easier. And that is the new change with SMSF Lending. It's become easier.
Yeah. So I think like two examples that are on the top of my head because I've been kind of working on them this week that I think kind of showcase who like it can suit. So one couple, both professionals, both PAYG. We've been working with them over the last like 4 or 5 years. They've built up their investment portfolio and a PPOR. So they've got a couple of investment properties and a PPOR. All purchased kind of before the rate rises and now basically in a position where servicing wise, only the most extreme lenders would give them anything for residential lending. High rates, not a very attractive way to kind of keep growing the portfolio. Didn't have an SMSF set up, like had their super just with their employer, whoever went to by default, like went through the numbers, got their SMSF set up, put their funds in, had a couple of $100K then sitting in the SMSF and can do I think it was about a 650 purchase. SMSF awesome. And you're getting, the low sevens. So you're only fractionally higher than what their variable rates are on their, personal property. So it's someone that, has effectively purchased the next asset in the SMSF where they were effectively tapped out in personal names just by exploring that option.
Exactly. That's so good. So that's essentially how it works. That's the group of people who it suits. The one thing that I'd add to this is SMSF refinances are very attractive too.
That was going to be my next example was we've got someone who...
10%.
Yeah, more towards the end of his career. So income-wise and super contribution-wise, he wasn't showing that much. But he had a couple of assets in his SMSF for 10 years probably. Sitting with a major bank that actually no longer offers the product.
Like 10%.
Rates over 10%,
10%?
Right?
Oh my God.
So his rates are over 10% and his LVRs are probably like 30% now because he's been, paying them down. But anyway, on his scenario, because his LVRs are so low, the rental income on those assets covers the SMSF loan.
Yeah.
So he can refinance that SMSF loan to, again, low sevens, high sixes for him. And he doesn't actually need to show any contribution into his SMSF. It's just purely based on the rental income.
That one gets me upset. That one gets not at what we've done. That makes me happy, but that one gets me upset. If you're in that circumstance, if you have an SMSF loan with any major bank or any existing provider, take a look at that interest rate, and if it's double digits, definitely call someone. Please, it doesn't have to be us. Just call someone and fix that up because that's a ridiculous amount of interest that's just going out the door for no reason. We can't save any residential person that much money on a rate review or anything like that because their interest rates are not anywhere near double digits and pretty close to the market nowadays. But this is one where people are getting screwed by simply legacy. That makes sense.
And if you've held the property in the SMSF for a decent amount of time, there's every chance that the way SMSF servicing works, the rental income is all you're going to need to show. So your personal income position, how are you making contributions to super? Potentially not relevant at all as it was for this guy. Purely the rental income was enough to service the loan. So, wipe 3 percentage points basically off his SMSF loan.
Wow. That's good work for this person as well, but really, really good advice there. So SMSFs, great way to build up your portfolio, and also for those with existing SMSFs, refinancing definitely makes sense in this circumstance because there's really competitive products out there.
And the tests are easier.
Exactly.
If you've held it in the SMSF for a while, there's every chance that a lot of lenders will be like, yes, this works.
Yeah. Let's get on to trust lending. So this is one we get asked all the time now. Good on TikTok and good on all the property experts for making this seem like the best strategy of all time, which is what it's framed as from those that consume this content and come to us. But let's go through trust lending. This is a way to recycle your borrowing power and build a significantly larger property portfolio as a result. That is true. So the way this works is if you purchase in a trust and it's got no other entities, no other debts in that trust, the bank will look at that asset and will look at that trust and lend to the income in that trust itself. The reason why trust lending is so popular is because it allows you to recycle your borrowing power over and over again by setting up new trusts and isolating the debts that you have in other trusts away from your new loan application. So, explaining that out a little bit, if you set up a new trust, then you don't have any debts in that trust, you can get the bank to exclude all your other trust debts or all your other debts in other entities that you may have if they are positively geared and paying for themselves. So you can create a new trust for each purchase, for example, and you won't be including the previous purchase into your borrowing power assessments. The only calculations that they will do is look at your personal position and see if you can personally afford the debt that you're going to take on. So that is a key part of utilizing this strategy.
Yeah, it's not I think people sometimes get this confused. It's not an unlimited borrowing power strategy in the sense that your borrowing power doesn't have a number on it.
Yes.
Like your borrowing power still has a number.
Yes.
If that makes sense. Like you run the calculation, you have to provide a personal guarantee as, if it's a company, the director's guarantee or however you choose to set it up. And the bank is running the servicing based on your capacity as the person guaranteeing the trust or the company, right?
Yeah.
So that will produce a number, and that is your borrowing power. The idea of this strategy is that you can use that borrowing power multiple times for multiple purchases. So if that number is 600, you can use it once, purchase and for 750 get a 600 loan. Go again, you get the same 600 in the next entity, the same 600 in the next entity. So that's a distinction. And the other thing I would say with this is a conversation that we have a lot is banks are always balancing borrowing power and deposit position. And you can't burn the candle at both ends, so to speak. So this strategy is really, really good if you have the deposits available and ready to go. If you're looking for a strategy where you're recycling borrowing power over and over and over again, but you're trying to do it on very, very low deposits, like you're going to eventually run into trouble. So that's kind of the balancing act with it.
Yep. The circumstances that I'd add in is if you are purchasing in a trust and you want to deploy this strategy, have a conversation and work out what your trust borrowing power is up front. Be like, you need to work that bit up front.
And that has a number. It's not unlimited.
Yes. Yeah. The unlimited bit, I don't want to use the unlimited word.
It's a recycling.
Yeah, really I don't want to use unlimited because that is a marketing term more than anything. It will come home, you will reach a cap at some point, and if your income's not extremely high, banks are going to start being wary of someone earning 100 grand trying to do this repeatedly, being like, no, I don't want to lend.
And you need the deposits for it as well.
Yeah, exactly. So the reason why it is attractive is you need to work out what your trust borrowing power is. So let's just say you work out you have a $500,000 trust borrowing power. You may want to purchase a little bit underneath that, because if you do, and let's just say you provide a 20% deposit, if you do, then you may be able to go back and access the equity that you have made through your purchase if you borrow beneath your trust borrowing power. So if you have $500,000 in your borrowing power in a trust, you go buy something for $400,000, and then you go buy something else in another trust for $400,000, and then another thing for $400,000, and you have 3 of these purchases, you can do that. That's the beauty of this, versus if you did it in a personal name, you're only going to buy one $500,000 asset or $500,000 borrowing amount, and you're done. Like, you're not going to be able to get it anymore.
Yeah.
So that's the beauty of it. Now, by borrowing less than your total trust borrowing amount, once you've got some equity, once you come back in a year or 6 months or 12 months, 2 years, however long it takes for you to build up some equity, and hopefully you've listened to the previous podcast and now you know how to buy areas that are about to go boom. If you've done that and you make equity really quickly, if you have borrowed beneath your total trust borrowing capacity, then you can go back and being like, look, hey, can I go release my equity in my trust that I have here? And because your trust borrowing power is 500 and you've only borrowed 400, you can release $100,000 worth of equity. And then you could take that money out and then repay the deposit loan that you may have come from in your personal situation. If you've taken out a personal sort of deposit loan against your owner occ or some version of that, taken out a mortgage in your personal name, you can repay that, or you could use it to go purchase further investments. That is a effective sort of taxation approach as well, because the amount that you deduct out in a trust, the amount that you borrow out in a trust is likely to be deductible, versus if you did it in a personal name, it may not be deductible because it's about the purpose there. So there's a little bit of a tax benefit there as well, potentially subject to tax advice. Everyone get your own tax advice here. Anyone employing this strategy, get your own tax advice. You'll need it. You'll need a good accountant working with you, because you're going to be borrowing. You're going to be bugging them with accountant letters every few weeks if you're going to go deploy this strategy. So this approach allows you to recycle your borrowing power multiple times. One little cheeky thing I like. Let's not go specific with lenders, but the lenders that do this, there's a number of them. There's one of them that does it so well because they do it quickly, and that's the number one issue with this approach. Getting a loan in trust is complicated. It takes significantly longer, and bank SLAs, so timing to get approvals, goes from 1 day or a few hours to 10 days or 3 weeks or 4 weeks. It can take a long, long time, and it can rule out a whole bunch of lenders. But one lender allows you to do it with them. Like, you can go create a new trust with them each time, and they'll exclude the other trust, which is really funny because they have exposure to it and they can see it all, but they'll still exclude it. And, we're talking about one of the better lenders here. We won't get specifics into names here, just because we have got accreditations and we've got people to, we've got bosses effectively that could come down on me if we go too deep into it. But one lender does that. And another lender, this one's really cool, doesn't even need an accountant letter. They'll be like, nah, don't worry about it. Like, we don't even need that. So, we don't need that paperwork. That makes it even easier for you too, from a procedural perspective, but they take a really long SLA. So there are some lending downsides in terms of the amount of paperwork, the complexity that you're adding to the structure, the accounting costs. Accountants love this because there's a lot of accounting costs.
Yep, a lot of entities involved. Yep.
Yeah, a lot of tax returns to do. You have a couple $1,000s a pop each time you have this every year. So accountants will like this. But there's some downsides to this as well, but it can work. And I don't know how future-proof this is. We've talked about this a little bit. Is how sustainable is this? What do you think? Putting you on the spot here.
Not very. So the idea, I would say, the idea banks are running with in order to allow these approvals is they're basically not seeing the directors' guarantees that you've made to other entities.
Or not caring about it.
Not caring about it.
Yep. They're not seeing it, and they're not caring. In some cases. In rare cases,
they can see that you're a director, right? Yes. So they can see that you're a director of the company involved.
Yep.
But they're basically letting the accountant's letter, or, in some cases not even requiring the accountant's letter, they're just letting that go.
Yep.
But it would not surprise me with comprehensive credit reporting, and we've started to see this already on a couple of people's credit files, where guarantees that you've provided are actually listed on your personal credit file.
Yes.
And if we reach the point where banks can see the liability on your credit file that you've guaranteed, I can't see a world where they exclude it. Like if it's there.
I think some might, but like I just talked about one lender that allows it with their own lending. So they know about it clearly because they've got the other debts, right? I think some may continue it, but is it sustainable if you can see it and if there's no lenders out there doing it? And how realistic is it that each lender's approval process is known? We talked about this in our last pod where we said, if you know certainty that you're going to get funding, that allows you to negotiate better and you have comfort in your ability to know that a deal is going to get done. In the future, if you're relying on this strategy and panning out years ahead, that has uncertainty attached to it because we have open banking coming in, which is the financial passport that everyone has, and we have comprehensive credit reporting that showcases more and more data on each individual, and we know more about you now. There's less to hide, and when the banks know more about you and they see it, they may ask more questions. And if they can see the debt amount and they can see when you got it and which provider it's with, they're more likely to be far more uncomfortable with you going and getting money.
Just excluding it, yeah.
Exactly. Now, if you're a really high income earner, we've got this sort of solution. It's the nature of lending. It's just the truth. If you're a really high income earner, banks often find a way, look, I just lend against your character. Like, we'll exclude it all. Private banks will do that, for example, a lot of cases. Be like, hey, you've come to us. You're clearly a private customer. Yeah, we'll exclude it. We can make it work. But if you're earning 120 grand and trying to do this and, just a normal worker, and you're going to rely on this, in a world where it's shown and seen, more and more lenders are going to start excluding this, and you're not going to be able to do it sustainably going forward. So that's something to be aware of. It's it's a loophole that may not be there forever.
Yeah. So again, to give a couple of real life examples that I've been working through, like two different customers. One, I think it works really well for, and one maybe not. So one person already has like a resi portfolio in their personal names, coming towards the end of their borrowing power and thinking, all right, maybe do I set up some trusts or companies in order to get one additional property or a couple of additional properties based on their kind of funds available to go towards the deposit. We ran the numbers. Setting up trust or companies would maybe allow them to make one extra 400K purchase. Pretty marginal. And then the plan was, I can set up another company and another company maybe in 3 or 4 years' time after my portfolio has grown because I've already released all the equity. So for them, it's a bit more debatable as to whether going through all this effort to set up the trusts in order to make one small acquisition with then a very uncertain timeline for how this is going to play out in the future. For them, it's maybe weighing more towards, look, it's not worth going down this path.
Yep.
But another person, they've luckily received a fairly large family inheritance of a few $100,000. Not a single parent, not on a massive income at the moment. So borrowing power wise, their borrowing power is not that high. But they've got all these deposit funds, and they don't have an investment portfolio at all. They want to use this inheritance, this gift that they've got, in order to get a portfolio. So for them, their situation is almost, the total reverse, where if they choose to do it under personal names, their borrowing power supports one investment purchase, you're done. But if you wanted to set up this trust structure, you could utilize that, large, several $100,000, deposit base to grow a portfolio of, 5-6 properties in the space of the next couple of years if they wanted to, where you're less likely to run into, you're not planning for something that's 10 years down the track. They've got a bit of a pathway that they can roll out. So it works for them in that circumstance, but it's not something that we kind of talk to people and being like, look, this is guaranteed to work for the next 20 years. Set up your affairs this way. So, you can do one now and then one in a decade's time.
Look, I think most investors, the majority of people listening to this even, they're not looking to buy investment property after investment property after investment property after investment property and try and build a massive property portfolio that way. That isn't the majority. Sure, some people have that risk appetite and want to go and do that and want to, have a huge property portfolio on a small income. Yes, some people want that. But the majority of people want to have a property portfolio proportionate to their income. So as they grow their incomes and as they develop their savings, they're like, look, I've got a little bit too much savings here. Let's go invest in property. That sort of investing is the majority of investors. It's why most investors have 1-2 property investments. That is a healthy, sustainable way to grow wealth through property and grow wealth in general, to match it up with your income and as the life cycle that you're in. If you're in that boat, and the majority of people, I would say, look, this is an advanced strategy. And yes, there's a lot of attention to it. There's a lot of highlighting of it from people in the industry. But the reason why they're highlighting it is because quite often they're using it because they're very high income, doing really, really well and trying to continue to advance their portfolio. And they're in the industry that works on transactions. So they're trying to do a lot of transactions. So they want to keep you lending. But the majority of people aren't in that boat. So a lot of our work is actually an educational piece with people and being like, look, what boat are you in? Are you necessarily sure that you want to go down this trust approach up front? Is that the sort of investor that you want to be? Because it has downside, it has consequence, higher transaction costs, just more painful, really. It makes the whole process more painful. That pain is going to dissuade you from investing. And do you want to do that from day dot? The one advantage I do like about this approach is for those that want to buy their owner occupier later, those rent investors that are on good incomes that want to preserve their owner occupier borrowing power, but want to invest in property first. So let's just say you're 25 to 30-year-old couple, you're doing really, really well, and you want to go buy a home in 5 years' time in Sydney or Melbourne, but you don't want to do that now because it's too unaffordable, you can't live where you want to. You can rent vest with this approach and preserve your owner-occupier borrowing power because your end goal may be, I want to buy my home in Sydney, and these investments should support that end goal.
Yeah.
One downside of doing it in your personal name is all of these investments are going to soak up your owner-occupier borrowing power. But if they're in a trust, then you are preserving your personal position that you can use.
Yeah, when it comes time. Yeah.
So that is one attractive approach. And obviously the recycling of the recycling of your borrowing power and the ability to release your deposits back out if you've set up your affairs appropriately and planned for it appropriately. Those are some common things to look out for, and be aware of the lender selection being a little bit more reduced and the uncertainty to the future position associated with this too.
Yeah, I think like high level, like it does work, like it is possible,
100%.
but there are a lot of strings attached to this one and it's not something that suits everyone.
Yep.
It's kind of the flavor of the month. Like we have more conversations about this strategy than any other like recently, but yeah, it suits particular circumstances and particular objectives.
Be prepared for a world of admin pain.
That's true.
So like perhaps I'm saying this because we're mortgage brokers and we have to deal with a lot of the paperwork stuff, but it's so slow. It's just so annoyingly slow buying in a trust. Like the major banks, like we're turning over applications same day regularly now, or within a day or two, approved, done, next. Like it's so simple. It makes your life so much easier. You digital sign documents, it just makes the whole process simple. Versus you do it in trust, you could be waiting 3 weeks for your loan approval, constantly asking what's going on. We did one recently for a borrower that could easily borrow, such an easy applicant, and it took like 4 weeks. We've got another circumstance where it took another like 3 or 4 weeks.
And when you get the documents, you're gonna need a solicitor to witness stuff. It's administratively, it's a bit of a mess.
So painful, and which can dissuade you from property investing in total. So for those that we see this working for is generally those advanced investors that want to build large portfolios, or those that are going to have really high incomes later. It really suits them.
Yeah, and it's got to get you a materially different outcome to what you would be doing if it was your personal name, if that makes sense. Yep. If taking on this strategy is going to make a marginal difference to you, then a lot of those strings make it not that attractive. If it's going to materially change what you can do, and that's kind of where you want to take it, then it's kind of worth wading through the mud to make it happen.
Of course. Let's wrap this up, Kurt. We have gone through 3 of the 10 lending hacks that we had in mind. There's another 7 to cover, so let's leave that for our next pod that will come out in a few weeks. We will get this all out, all the lending hacks to help you grow your portfolio. The rest of these are more about niches, little things that you did or did not know that can help you grow your portfolio. And it's all about what specific lenders do to help expand, rather than these investing strategies that we talked about in this podcast, where we uncovered commercial lending, trust lending, and SMSF lending in a little bit more detail. Those are strategies, really. Investing strategies and financing strategies to help you build your portfolio. The rest of the 7 that we have here are about lending niches and policies that you could know that could help expand your portfolio and help you get that little bit extra if you needed it.